Number 14. Number 14 gives us some information and wants the return on investment for the Penn division. All right, so remember, return on investment is operating income divided by average total assets. So the first thing I have to do is average the assets out. All right, so the average assets for Penn are the 580 plus 610 divided by 2, which is $595,000. All right, and then return on investment is the operating income of 100 divided by the average assets of 595. So 16.8%. Oh, and I didn't round to 2 decimal places, sorry. That's okay. All right, number 15 wants residual income. Okay, residual income, or RI, all right, that means that's residual income. Residual income is your actual income minus a minimum acceptable. And that's your residual. Okay, the minimum acceptable is your average assets times the desired return, which is a percentage. Okay, now in this particular case, they actually gave us the minimum acceptable operating income. All right, their actual return is 35%. All right, this is the actual return on investment. This 520 was calculated using the corporation's desired return, which is a little bit lower than their return on investment. All right, so residual in this case is very easy to calculate because they gave us all the numbers. So we've got operating income of 705 minus a minimum acceptable, which is 520. So my residual income is $185,000. All right, the last 2 questions have to do with transfer pricing. All right, Adam Incorporated has a division that manufactures a component that sells for $150 and has a variable cost of $30. Another division of the company wants to purchase the component. Fixed cost per unit of the component is $20. What is the minimum transfer price if the division is operating at capacity? All right, operating at capacity means that they can sell everything they produce to the outside market for $150. So if they can sell everything they're producing to the outside market for $150, then another division in the company should have to pay that same price as a transfer price. So since they're operating at capacity, the minimum they're going to want is the $150, which is the current sales price. All right, number 17. Raphael Incorporated has a division that manufactures a component and sells for $190 and has a variable cost of $35. Another division wants to purchase the component. Fixed costs per unit are $22. What is the minimum transfer price if the division is operating below capacity? All right, this means it has excess capacity. Fixed costs aren't going to change. The only thing that it's going to cost Raphael to make another unit is the $35 variable cost. Okay? So if another division wants to buy something from Raphael, the minimum he'd be willing to accept is this $35 variable cost, because that's all it will cost him to make another component.